Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends? Hey, I'm just trying to make you a little money. My job is not just to teach you, but to educate, entertain, too. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. In any given market, you need to understand the themes, what's really going on, not in the averages, but underneath. So on a day where the Dow lost 224 points, S&P shed 0.08%, but the NASDAQ, where the hottest stocks are, gained 0.35%. Let's take a moment to figure out where the money's going and where it's coming from. Let's do the winners first, as they are stark and glaring. The first and most exciting group are the tech companies that suddenly feel like they've been immunized against tariffs. Yesterday's shocking decision by the president to bless Apple after CEO Tim Cook pledged $600 billion to build up American manufacturing. Well, that changed the coloration of this entire market. Suddenly, instead of Apple being a hunted beast, with the president going after them for making phones in China and then going after them for making phones in India, Apple became one of the president's favorite companies. Hence the remarkable 3% gain on top of a gigantic increase just yesterday. Oh, it's a remarkable turn. Come on. President Trump was unmoved when Cook promised $500 billion over a 4-year time frame to build back American manufacturing. Cook wanted to make those phones in India and export them here. Trump wanted phones all made here. But then Cook added another $100 billion. And that was enough to sway the CEO-in-chief. Come on, this is a staggering amount of money, even if some of it was already baked in. Remember the CHIPS Act under Biden? Do you know that was only $280 billion, less than half of what Apple's offering? And of that spending, only $39 billion went to direct subsidies to encourage semiconductor manufacturing. Meanwhile, Apple can shell out $600 billion without batting an eyelash. What a country. The implications of this blessing are far-reaching. When the week started, Apple stock was continuing to drift lower, looking like it would fall through the $200 mark, down from $214 after reported a meaningful upside surprise last Thursday night. Concerns were twofold. First, where was Apple's AI strategy? Are they going to team up with one of the chatbots? Perplexity being the easiest because it's independent. Are they going to seek to be paid in some fashion other than an outright check? Something that could earn them the ire of even this Justice Department. In return for a steady flow of traffic, could they work a deal with Anthropic, owned in part by Amazon, to a lesser extent Google, yet it feels like it's an orphan and acts like one too? Without more knowledge, Apple's being hectored endlessly as an unimportant Johnny-come-never that's missing out on a major opportunity. The other bigger issue, though, was President Trump's very palpable enmity. I kept hearing that Cook and the president didn't get along because he wouldn't commit to making the iPhone in the United States. The drumbeat grew so loud that I even asked Tim in my private chat with him that I have a private chat with him right before the quarters reported. And you know what? I said, is it possible for you to work with the president? Tim, can you work with the president? He came back and he said that he has good relations with the president. Good relations. Now, the president often says he has good relations with someone like President Xi from China, who he clearly sees as an adversary. If Trump is friends with Xi, I can only wonder what he's like with his enemies. And Apple sure seemed like an enemy. That was the setup coming into the week. But Tim Cook, if he says the relationship is good, then it is good. And that gave me the guts to tell you to stick with it. Now, with the stock at $220, nicely above where it was when the company reported, I need you to think about what has happened in the last 24 hours. After horrendous hand-wringing that there now looks to be no tariff on iPhones. None. Whether it be reciprocal tariff or the 50% India tariff that was going to put the kibosh on Apple's earnings. But how about its biggest competitor, Samsung? Have you been thinking about that one? I've been noodling. They own 31% of the U.S. market, number 2 to Apple, according to a recent survey from Canalys. Can this Korean company get the relative free ride of a 15% tariff, the rate negotiated by South Korea? Or could you argue it should be hit by a much larger tariff that embraces all of the foreign semiconductors, which are now being tariffed at 100% and are embedded in the Samsung phone? Could there be a special tariff, not just on semis, but on all cell phones, save Apple, that are not made here? Could Apple go from being the most expensive to being the cheapest, the best one for the phone companies to offer so they can get new accounts? Isn't that what the stock's monstrous move from 203 to 220 in just 2 days is telling us? The pin action from the Apple deal with the White House reverberated through almost all of tech, making it a terrific sector to own. I say almost because against the major court of traditional tech, we had the minor court of a collapse in the cybersecurity cohort because of a disappointing quarter from firewall builder Fortinet. Stock plummeted 22% in response to that. As is often the case, there's too much collateral damage to others because they're all connected by an ETF. So CrowdStrike goes down, even though it's not a firewall company. It's a company that protects the cloud. Yet it was down almost 6% because of the markets practicing collective punishment. I say that's like selling hardware stocks because software's down. Oh, and by the way, software, whoa, the enterprise kind, that is just getting crushed. Think about this. If it involves coding, it's horrendous because AI, we don't need a lot of coding. I like to look for stories that have been red hot, okay? That have suddenly cooled purely because of guilt by association. This morning, Morgan Stanley put the wood to Caterpillar, downgrading the stock from hold to sell because of worries about tariffs. Look, there are issues with CAT, but we already know them. The company reported last week. I mean, we know everything about it. Got the conference call. I don't want to buy CAT, even though it'll get its fair share of reshoring orders. But the downgrade also temporarily stopped the legendary rally in the big three of engineering construction. Write these down. AECOM, Jacob Solutions, and Quanta Services. Now, I've been waiting for an opportunity. I wish these stocks had just cooled off for a second so I can tell Investing Club members to buy them. There will be too much business from the more than $1 trillion pledged by foreign governments and the nation state of Apple to rebuild American manufacturing. These three are going to get the lion's share of the contracts. And I kept thinking their stocks were unlikely to make any sort of break. Now you're finally maybe getting a chance to buy them on weakness. Last and least, I look at the drug stocks, and I can't believe how awful they really are. With now Eli Lilly at last joining the ugly fray, with its less than impactful, less thought weight loss. The pill. The street was hoping that Lilly would be able to replace its onerous GLP-1 injection with a simple pill that would produce an equal amount of weight loss. No such luck. The stock, it just got poleaxed, laid to waste. Only Johnson & Johnson seems to be above that fray, but I think that's in part because it's a medical device maker. That's the only hot area of healthcare right now. It is even why lowly worm Danaher caught a bid, and it's why Apple has no quit. Now, days like this, we should really celebrate, okay? And we should remember. I always say, you know it, Apple, don't fool around with it. Don't trade it. I say it because this is a company that always seems to get it right in the end. It's like the damsel in distress tied to the railroad tracks as a speeding bullet of a freight train barrels down on her. At the last minute, she always springs free. Of course, there's a reason with Apple. It's a confident company with the best products on earth that's run by one of the greatest value creators on earth, rivaled only by Jensen Huang at NVIDIA. So here's the bottom line. You need to think about the last 24 hours. You need to think about it and where this Apple stock has come from. You need to know what this is, why I say own Apple, don't trade it. And you need to obey that mantra or just go buy a darn index fund, because if you're not willing to trust a company as great as Apple, what is the darn point of owning any individual stocks anyway? Anthony in Pennsylvania. Anthony.
Hey, Jim.
Anthony, what's happening?
Kids and I watch Mad Money every single day. We appreciate you. We love your energy.
Thank you, buddy.
UNH, United Health. I wanted to talk about that company given the current healthcare policies, landscape, and rising costs.
You know, I have long, first of all, thank you for those kind words. I have long known, this is something I learned probably in my second decade of trading or investing. You do not buy or sell something where you have no idea what is really happening. And at United Health, there isn't anyone other than the CEO and probably 52,000 lawyers who has any idea what's going on. Anyway, the last 24 hours for Apple have only reinforced what I say. Own it, don't trade it. And if you can't follow that advice, then you should just go buy an index fund, and maybe I'm going to switch to ESPN or something for all I care. Oh, man, just kidding. I love you. I love you, right? I love you. Oh, man, Money tonight. Papa John's is soaring after earnings. I'm finding out what Wall Street found so delicious about this quarter with the CEO. Then Pinterest reported after the bell. They had some very interesting to say about Gen Z, but who doesn't? Don't miss my exclusive. And E.L.F. Beauty is struggling to navigate tariffs overseas. I'm seeing what the company has to say following today's major client. And don't forget, Rode. That's what the people, the women in the office say. Rode, Jim. You got it like Rode. I don't know. To me, it's like Cormac McCarthy. I'm wrong. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This morning, Papa John's delivered a terrific quarter, sent the stock up nearly 9% today. Thanks to better ingredients, better pizza, and better value deals, the company posted higher than expected sales, 7% earnings beat off a 34-cent basis. Not too shabby here, just over a year ago. Todd Penegor came in as the CEO with a bold plan to turn the business around. So is it already paying off, or do we need to be maybe a little more realistic? I don't know. Let's take a closer look with the man himself, Todd Penegor, President and CEO now of Papa John's International, to find out more. Hey, Todd, welcome back to Mad Money.
Always great to be on with you, Jim. Thank you.
Oh, it's good to have you. Hey, Todd, before we get started with an excellent quarter, I have in front of me a croissant pizza. Now, I've got to tell you, I'm used to Papa John's not having all that much innovation. This is the kind of thing I expect from a Todd Penegor. How's it working?
Working great internationally, Jim. Flaky, buttery, really brings to life the craftsmanship that Papa John's is known for. Highlights our better ingredients, better pizza. Really helping us really drive strong comps in our international business. We're slowly rolling it out globally. We highlighted it as a global launch when it showed up during Paris Fashion Week on the runway, so we got some great PR from that. Don't know if it'll make it to the U.S., but I would never say never. This could be an item that eventually gets to the U.S., but we're going to continue to innovate with really cool things that are unique, different, and better, and only from Papa John's. And you'll see more of this coming on our innovation calendar the rest of this year and into next year.
Well, you know, it's interesting, Todd. This is the kind of thing, along with social media, which I know you understand better than most anybody in the business, that attracts this whole cohort of Gen Z that people are having a hard time finding. This and your technological background really helping you?
It is. I think, having Kevin Vasconi and the team on board, we got a tremendous amount of data. We can connect to the next generation of consumer. I think our messaging around 6 simple ingredients, fresh, never frozen, original dough, all of those things are so on trend for today and really allows us to tell our story, why we are better. And when you think about better ingredients, better pizza, and how we pay it off, those are the things that we bring to life every day in our restaurants. We're full, make from scratch, and we got to deliver on that promise. Leveraging technology and leveraging great ops day in and day out.
Let's stick with that technology point for a second. In the conference call, you say in April, we announced a partnership with Google Cloud aimed at transforming our customer experience from click to crust. Now, I am now beginning to believe that with Google Cloud, with, frankly, AI, we can phase out coders who were an expensive blocking point and get right to the consumer. How's this Google Cloud working for you?
It's working great. I think the amount of time from the time we have an idea to the time we can actually develop and bring that idea to life has dramatically shortened. We're moving quickly to really drive how our app continues to evolve. And we've got a new app out there in beta, which actually takes the clicks down, a better user experience. We're leveraging Google partnership with Flutter to be able to do it both in Android and in the Apple world. We're moving fast, and we're bringing stuff to life with the agility and nimbleness that you would expect from a fighter brand.
And, it's funny. We used to talk about the idea of maybe at Wendy's utilizing voice. It wasn't ready yet, but the AI solution might work for people. We have people of 25 different languages in America, and those people, why not try to get everybody?
There's some opportunities for us to kind of leverage voice and leverage generative AI in our business, but it's not just around the ordering experience, it's around the group ordering experience, but even operationally in our restaurants. We spend a lot of pride in grading our pizzas after we make them. It's all manual today with a visual cue. I mean, we can leverage AI to grade our pizzas to make sure as it goes out the door, you have a great pizza really made with the craftsmanship you deserve. So we're going to lean into those things as we move forward.
Okay, let's talk about value. I think value is increasing. We're dealing with a lot of people who feel stretched, or actually, I think feel a little bit, they're uncertain, and they want value when they buy. $6.99 Papa pairings is the kind of thing I guess people are really looking for right now.
Well, $6.99 Papa Pairings has always been on our menu, but we hadn't talked about it a lot before I got here. And we've had a regular cadence in our media mix to make sure that they know that's always been on the menu. It's great value. It drives customers in, allows us to stay really relevant at a key price point. And, for 2 medium pizzas or other sides that come along with it, a great offer. But we also have our revamped loyalty program, which is a whole nother way as we lowered our threshold, $2 off a $15 purchase, real hard, cold cash. That's true value. And we can connect to that consumer in our loyalty program, really talk to them in a more hyper-personalized way to change behavior to drive frequency. And that's what we're doing. And you're starting to see that roll into our results in North America. And we're leveraging those learnings from North America to take them international. And we got a lot of momentum in those
international numbers, really sensational. Now, I did notice on the call, you did talk about comparable store sales in North America, down 1%, citing more cautious consumer, softer carry-up, but you are bullish, more bullish than the end of what we've seen these last 5 weeks. What makes it so that you think you can get back on track there to continue with good growth?
Yeah, if you look at where we were in the second quarter, being up 1% on North America same restaurant sales, really on the heels of 1% customer count growth, which is awesome. The second quarter, we just didn't have a strong enough third quarter start. We didn't have a strong enough carry-out offer in play. But you start to look at what we have coming. We got garlic 5-cheese pizza, great innovation, off to a great start, just launched this week. We got a shareable, dippable pizza that really leverages the sauces that we have, only unique from Papa John's. That's coming later in the quarter. And we're going to continue to lean in to leverage our loyalty program and CRM to connect to the consumer. So we think we can continue to build momentum through the quarter, and we'll have an appropriate barbell strategy. We'll be talking about the premium innovation, but we'll also make sure we got a good, steady message on $6.99 Papa Pairings moving forward.
I'm also glad, Todd, that you've got a feature that had been a limited time only that is not. This is the Shaq-a-Roni. It's not just a pizza. It's a slam dunk, as Shaq would say. Is it just a gimmick, or do people order it?
People order it. The Shaq-a-Roni mixes really well. They used to wait for it to come in the fall. We've now got it on as a regular menu item. It's mixing quite nicely. It helped us really turn our comps positive in Q2. So we're going to keep that on the calendar. People associate our brand with Shaq. He's been a great spokesperson. And we'll continue to leverage and lean into that great product. It's great value for the money.
All right, one last question. Is there a possibility that pizza could be getting a little commoditized? Look, the restaurant business. I see the different pizza players offering very similar pizzas in terms of what what's on the menu. Can things be differentiated enough that Papa John's has a place where people say, that's not the same as the other guys?
Yeah, I think we just need to get back into what our rightful history has been around some great innovation and bring some news that's unique and different, and you would only find with the craftsmanship from Papa John's. So you see that with the steady dose of innovation that we talked about. We got this offering that is coming out with the Grand Papa later this year, our biggest pizza ever, which is going to be great value. But we're really working on not just pizza and crust innovation for 2026. We're looking at adjacent categories within the pizza business. And if you think about your hometown pizzeria, what else could we do out of our restaurants? We've slowed our ovens down. We took our bake times up. We did a bunch of oven calibration. It's really opened up this world to have more innovation, to make sure you got more choice from Papa John, to not just be the best pizza makers in the business, but we can really be the best bakers in the business over time.
All right, well, that's going to matter because the stock was up nicely. You get that 4% yield. I like that combination. That's Todd Penegor. He's coming from Papa John's, President and CEO. That's PZZA. Todd, always good to see you on the show.
Always great to see you, Jim. Thanks for the time.
Mad Money's back after the break.
Coming up, Pinterest just gave us a look at what's on the inspo board for the second quarter. Cramer's scrolling through the earnings with the CEO. Next.
What do we make of these numbers from Pinterest, the social media platform / virtual pinboard site? Now, your stock has been doing pretty well, but when the company reported after the close, stock got sand in after hours trading. Even though Pinterest delivered a solid set of numbers, healthy revenue forecast for the current quarter, their earnings per share came in a tad light. At the same time, their user growth and revenue results were softer than expected in the U.S. and Canada. Most of the outperformance came from Europe. Look, I thought there was much more good than bad here, but the market's initial reaction makes me wonder if the expectations were too high. Don't take it from me. Let's dig deeper with Bill Reddy. He's the CEO of Pinterest to get a better sense of the quarter and what's next. Mr. Reddy, welcome back to Mad Money.
Hi, Jim. Thanks for having
All
me.
right, so, Bill, obviously, the market is taking the stock down late, and I've got to tell you, it's the EPS number, even though the revenues were good. And by the way, the EBITDA results were great. So tell me what the market may be missing, or did you skip a beat here?
Well, I don't know. Is a beat and raise quarter, so we feel good about that. But more than sort of the expectations in the market, we really look at did we do what we said we were going to do? And we delivered revenue growth above the high end of our guide at 17%. We're at all-time highs on users. We had accelerating user growth in our UCAN region and Europe. And so, we really feel good about that, and the fact that we're winning with the next generation, with more than 50% of the platform being Gen Z now. And really at the core of that is what we've done with making AI central to what we're doing in the product, where Pinterest has really become an AI winner and is driving increasing engagement across the platform. So all those things we feel really good about, and we feel like we're doing what we've said we would do, and we're going to continue to focus on that and execute well.
Well, let's drill down on that success with Gen Z. You've spent a lot on AI machine learning. You're very successful at it. It seems like we can actually, they say you're an advertiser, you can kind of get the zeitgeist of this generation. I see you talking about the value proposition for advertisers, about what people keep calling up and looking at. It shows you that that Gen Z loves you, but is also stretched.
Yeah, that's right. I mean, a couple things I'd say. One, in terms of this notion of Gen Z is searching differently. We see that happening with lots of new kinds of experiences in this sort of Cambrian moment for AI, where users are engaging with new kinds of search experiences. We've launched our visual search, where we talked about on the call, our new multimodal visual search model that we use for visual search outperforms off-the-shelf models by more than 30 full percentage points. When you pair that with the curation on our platform, the recommendations we make lead Gen Z to say things like, Pinterest just gets me. And so that's really driving more and more usage on the platform, but it's also driving actionability. And so to your question on advertisers, it's also the case that advertisers are seeing that increasing actionability, where that's driving clicks and conversions for them. And that's why you see, our revenue growth consistently delivering, at the high end of our guidance, or above the high end of our guidance. And so we feel really good about the fact that we're growing faster than the market overall, increasingly winning with users, and doing so across geographies, across gender, and across generations. We're broadly relevant there.
Well, do you think you'll be able to get I know you got the MAUs, most average users high, but can't you make a little more money overseas, something similar to what you get in the U.S. and Canada per person?
Oh, you're exactly right, Jim. International is a huge part of the opportunity for us. We have approximately 80% plus of our users outside the U.S., but only about 20% of our revenue. And so, over the last 3 years, we've really driven a transformation in the business. And we started first in our home market, but international is a big focus for us going forward. And if you look at the quarter, we're seeing really great revenue growth both in Europe as well as rest of world, and those are accelerating, or places where we think there's an opportunity for us to do even more, and we're just getting started in those places. But at the core of it is the visual search, the visual relevancy. Those things are working on a global basis, and the retail and shoppability of our platform is also what's working in those regions as well. So we think that's a global phenomenon, and where we're just getting started with what we can do internationally.
Kudos to you. Before you got there was no shoppability. You would look at it and then kind of go somewhere else. I know I was talking to my daughter the other day. She has to go to a wedding, and she had to get a wedding dress. She goes to Pinterest now. That's not something that people used to do. And then finds the link and buys the dress. It would be amazing to find the link right there and buy the dress, not even have to just go to the link. But I imagine that's next for you.
No, that's exactly right, Jim. The actionability of the platform has increased significantly. When you ask Gen Z why they come to Pinterest, at the core of that is the shoppability of the platform and our ability to make really great personalized recommendations to them that's really driven off of our AI. But we're driving more of that actionability. For example, on the call, I talked about a new partnership with Instacart, where the food and beverage category, that is one of our largest endemic categories and was one that we had not gotten to yet with actionability. We're partnering with Instacart to make it so that when you find that recipe on Pinterest, you can press a button and get those ingredients delivered to your door through Instacart. And there's a lot more of that we can do to bring even more actionability to the platform. But it's really been core to the revitalization of the platform, the actionability we've brought already, but there's a lot more for us to do there.
Well, what are you going to do, Bill, about the tremendous content you have and how you have a lot of these bots just, I'm just going to use the word, plagiarizing from you. They take what you have. They should be paying you. You should be able to get a deal where an Anthropic pays you, a Perplexity pays you. Is there any way, I mean, look, you understand this well. You know that they're stealing, basically. Can't you get something from them?
Well, I've spoken publicly about this, that, I really think that we've been in sort of the Napster phase of AI, where, you have a lot of folks that, are taking content without monetization of that content. And it's hard to imagine a future where the people that created content don't get, an exchange of value for that content. And so one of the things that we're doing is making sure that we protect the publishers and creators on our platform. And so there's a lot that we're doing with that. To protect them from those kinds of things. But also, we're making sure that we're driving value back to them. So when I talk about that increase in actionability on our platform, how clicks and conversions are way up, well, that's also driving clicks and traffic to the publishers and creators that post on our platform, where they're seeing really good value from us. And so that is something that we think about in terms of building with AI the right way, both in terms of how we are thoughtful in creating value across the ecosystem, but also in building AI in a safe and responsible way, where we're doing things like private only for users under 16 and those kinds of things to make sure that we're delivering content that's going to make people feel better about themselves, and not just engagement via enragement, but actually tuning the AI for positivity. So there's a whole host of things around how to build with AI responsibly that we think we are part of leading the way in terms of responsible use of AI.
I definitely agree. And one last thing, I did notice that on the call, Gen Z user Patrick Schwarzenegger from White Lotus is involved using some novel way, but you should tell us how he's using.
Yeah, so he's one example of who is curating things on Pinterest for roles that he's preparing for, things like that. But men are increasingly coming to the platform. So we're a platform that has skewed towards women, which is fantastic. But we're also seeing that we are broadly relevant, and more men coming to the platform. And the reason for that is that the visual nature of the platform and the really great recommendations, it is broadly applicable across the globe and applicable across categories. So when I think about categories that, like, personally I spend lots of time in, like, shoes or cars or watches or things like that, it's very visual. And so you have men discovering that the things they're looking for, they can really find on Pinterest too. And we're going to make great, really relevant recommendations for them also. Well,
I think you're a great spokesperson, of course, for the brand, but also a great steward of the brand. And it's, I think, very, very valuable and very rarely on sale, as it is right now. Bill Reddy, CEO of Pinterest. Bill, I love having you on the show. Thank you so much.
Thanks for having me, Jim.
Mad Money's back after the break.
Coming up, the stock turned the color of lipstick after earnings. But does the business still have a good foundation? Cramer's brushing up on E.L.F. beauty with the CEO. Next.
What the heck just happened to E.L.F. Beauty? I mean, last night we got results from this low-cost cosmetics and skincare brand, and the stock got eviscerated today, down nearly 10%. We've long championed this one. It's been a great growth stock over the last few years, largely because it offers its customers quality merchandise at incredibly affordable prices. Unfortunately, it can charge low prices because it makes most of its goods in China, which means most of E.L.F.'s products are about to become more expensive. So last night, even though E.L.F. delivered a nice top and bottom line beat, management declined to issue a full-year forecast because they really have no idea how the tariff situation is ultimately going to play out. However, the limited guidance they gave did suggest that their margins are going to take a real hit. I got to find out more about this. Maybe that's why things got, just awry. Let's check in with Tarang Amin. He's the chairman and CEO of E.L.F. Beauty to get a better read of the situation. Mr. Amin, welcome back to Mad Money.
Well, thank you for having me.
Okay, so Tarang, this is one of the most confusing quarters because obviously you're in the crosshairs of China. At the same time, you keep opening new doors. You keep taking market share. But it is difficult to figure out how much you can make if the numbers can change. Why was that so difficult for investors to understand?
We're a little perplexed because we just delivered our 26th consecutive quarter of net sales and market share gains. In fact, out of 1,000 cosmetics brands in the U.S., we're the only one to actually drive market share up for 26 consecutive quarters. So we just stay focused on our core numbers. Certainly, I think investors would love to have seen us put guidance out there, but the reality is Tariffs have not been resolved. So until we get resolution, we decided not to provide guidance and continue to execute, continue to grow market share, and continue to pursue the white space we have.
Now, how do people feel so far about the fact that you did have to increase prices roughly by $1, which is, it's a price-sensitive market. Yours is well below everybody else, but that's still $1 means a lot these days.
We take our responsibility of delivering superior value very seriously. So in our 21-year history as a company, we've only taken price increases 3 times. We did announce to our community a few months ago that we're going to be taking our prices up $1 given the tariffs and other cost pressures. And, we had about 98% positive sentiment from our consumers. This is why I buy E.L.F. They're transparent. They care about value. Even after the price increase, 75% of our portfolio is $10 or less. So still a phenomenal value.
All right, so let's pivot to something that's very exciting that I think people may misjudge. Wall Street may be misjudging, but not the younger people in my office. The Rhode acquisition is going to pay off big, I believe, with the Sephora edition. This is something that is going to make people forget about the dollar, forget about the guidance, and focus on a major sales opportunity. How big? How big?
Well, we couldn't be more excited to welcome Rhode to the E.L.F. Beauty family. We just closed the transaction 2 days ago, and we're so excited, and so is Sephora. Rhode's going to be entering all U.S. and Canadian Sephora doors in September, followed by the U.K. later this year, and we love expanding our partnership with Sephora. We're also introducing E.L.F. in 6 Gulf cooperation countries in this later this fall, as well as introducing our brand Natorium with Sephora in Australia. So we love that expansion of the partnership, and we couldn't be happier with Rhode. It's another like-minded disruptive brand as part of our portfolio, and we have big plans for it.
All right, excellent. Now, I do want to talk about the possibility that maybe something's too downscale. I don't know. I have a Dollar General right near me. I like to go there. People say, oh, Jim, I can't believe you go to Dollar General. I say, I go where it's very inexpensive. Why not? No one does bad saving. Dollar General, right venue for you?
Every retailer who cares about beauty is the right venue for us. In fact, I know very few brands that could launch in Dollar General and Sephora Mexico in the same quarter and have both of them be exceptional launches. And the reason why is we offer a win-win. As we've looked at the data in Dollar General, our thesis was they serve the underserved. 80% of their stores are in rural areas with less than 20,000 people. And what we're seeing in the data is the people purchasing E.L.F. at Dollar General, 60% of them have never purchased cosmetics in Dollar General. And 53% of our purchasers are new to E.L.F. So it absolutely is a win-win, just like all of our other retail relationships. We tend to be the most productive brand a retailer will carry, highest dollar per linear foot, productivity, and it all is driven by our value proposition, powerhouse innovation, and disruptive marketing engine.
All right, so some companies are obviously switching their supply chain, trying to minimize their exposure to China. You have an unbelievably good relationship with China. I don't know whether it's worth risking, but have you thought about, I know some of your business is already out of China. Have you thought about moving more?
Well, we have been optimizing our supply chain. If you looked at us a few years ago, 100% of our production was in China. It's now about 75%, and we continue to diversify. But we're diversifying less to do with tariffs and more to do with meeting the strong global demand we have for our brands. International was the fastest growing part of our business this past quarter, or actually last few quarters. And so really to be able to meet that demand, we'll continue to diversify.
Well, last question. It's a kind of complex question, but why did the other guys still not see it coming? Why did Estee Lauder never cut price? They just felt like it didn't matter. I mean, did they realize that your stuff isn't that much different from theirs? I don't get it.
Well, we have very different models. We have a lot of respect for our competitors, but we are all about making the best of beauty accessible for every eye, lip, and face. And we're going to continue to follow that strategy because it's working.
And it just doesn't seem to dawn on people. I don't know how much their markup must be so much. It started. I think if people knew how outrageous it was, how little it cost them to make the stuff versus what they sell it as, they would just be even more drawn to your product.
Well, we've been picking up more consumers every single quarter. We're the #1 brand amongst Gen Z, the most purchased amongst Gen Alpha and millennials. And we're really picking up consumers in every age bracket. And it's through innovation like we just launched this last quarter. There's vitamin E, C, and ferulic serum. It's priced at $16, which is higher than normal E.L.F. products, But the only other thing like it in the marketplace is a prestige item at $185.
Yeah.
So we have an incredible value, and consumers understand that, and that's one of the reasons why we continue to pick up a lot of market share.
It's a big reason why I continue to recommend your stock, and I'm not changed yet. Tarang Amin, he's the chairman and CEO of E.L.F. Beauty. Tarang, I love you when you come on. You come on feisty. Thank you.
Thank you.
Absolutely. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
You don't pronounce the S. That's bro. You know, like, hey, bro?
I like bros.
Hey,
You're my bros.
hey, bro, taser you know?
It all starts at 9 a.m. Eastern.
It is time. It's time for the lightning round. In the box. Play yourself. And then the lightning round is over. Are you ready? Ski deck. The lightning round. Let's go to Stanford in California. Stanford, bring it.
Hey, Jim, how you doing today?
Couldn't be better. How about you, Stanford?
I'm doing great. I want to get your thoughts on Boeing.
Here's my thoughts on Boeing. Buy. Fair enough. Let's go to Andrew in New York. Andrew.
Booyah, Jim.
Booyah.
First time, long time.
Okay.
And on my birthday.
Oh, happy birthday, man. Happy birthday.
Thank you. Thank you very much.
You're welcome.
Yeah, I'm all about a stock that's been beaten up a lot, and we all love French fries. So what's going on with Lamb Weston?
Lamb Weston, man, the only potato chips I eat just folds. I got to tell you, I think it's interesting because there's a lot of people circling it, but I hate to buy a stock just because I'm hoping for a takeover. So I'm going to steer you away from that stock and from that group, which is really a nightmare. Let's go to Robert in Florida. Robert.
Good afternoon, sir. I'm a longtime fan of yours. Thank you for taking my call.
Of course.
Now, it wasn't too long ago in the cybersecurity sector, this stock was up and coming, but lately they just keep getting beat down. Are they just hype? What's your thoughts on Sentinel-1?
Just hype. How about Bill in Massachusetts? Bill. Bill, you're up.
Hi, Jim, club member. I just wanted to report I've been scooping up Honeywell and DuPont, making some nice positions.
You gotta be patient. We're gonna win big on those because they're breaking up. You're a good man.
Yes.
Bringing those to my attention. What's happening now?
Hey, I wanted to know what you thought of Hawk-Tan and Broadcom. We're making a fortune, brother.
Broadcom been one of, quietly it's been one of my best. But you know what? I like to thank Hawk-Tan. He, the CEO, had more to do with Broadcom doing well than me. And even my own hubris has to be checked. Let's go to Gordon in New York. Gordon.
How you doing, Jim? This is Gordon from upstate New York. I'd like to get your take on Key Corp.
I look at 4.7% yield with Chris Gorman being the CEO. I just say I'm not done. Let's go to Chuck in Michigan. Chuck.
Good evening, Jim.
Good
Booyah.
evening, Chuck. Booyah. What's happening?
Hey, after featuring this company on your show earlier this year, we started a position. The stock is up 32% year to date, even after a 12% hit. After a 2-cent miss on earnings earlier this week, with an 8.8% dividend, and it has beaten estimates regularly until now. Is this pullback a good buying opportunity, or is it time to take some profits in UL Solutions?
Oh, okay, so you had to be just 0.79% yield. Okay, so here's the problem with UL. That quarter was not really, when you have 40 times earnings, you can't have a quarter that's weaker. So we're going to have to investigate further. I am not going to tell you to pull the trigger on that one right now. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Still to come, are investors punishing stocks too much when it comes to tariff uncertainty? Cramer's looking at the post-earnings sell-off in one big retail name. Next.
Jim Cramer, the diehard of the dollar.
Hey, Jimmy, love the show. My 5-year-old grandson loves to watch your show.
I have to thank you for making us money when it's there to be made.
Our world is a better place with you in it.
unlike Shakespeare's The Tempest, in this business, what's past is definitely not prologue. Today, something happened on the Ralph Lauren conference call that was a harsh reminder not to expect that this market cares at all about what's already happened. It only cares about what's going to happen next. I heard the quarter. I got to tell you, it just finished before I went on air. I got to tell you, I loved it. Patrice Louvet is an amazing CEO, and Ralph Lauren's been a terrific performer, a real standout in apparel. The actual quarterly results were phenomenal. You got a true top and bottom line blowout, much better than expected, with much higher than expected gross margins. Louvet was effusive about the business, and I want you to hear what he said, which is what made me say this one could be a real winner today on Squawk on the Street. Here's how we put it. Quote, this quarter's performance underscores the power of our iconic brand with a unique ability to reach across geographies, cultures, genders, generations of consumers, the breadth and appeal of our lifestyle portfolio of products with timelessness, value, and quality more relevant than ever, and our proven key city ecosystem model as we continue to expand and elevate across every consumer touchpoint to be even more personal, more engaging, and more digitally connected. That's everything I wanted to hear. Music to my ears, right down to the guide up. So I go out hard in favor of the stock on Squawk on the Street before the market opens, okay? Emphasizing how Ralph Lauren's never out-of-style brand can transcend all the negatives that we keep hearing about every day. There's only one problem. They can't. Yep, they can't actually transcend the coming negatives. While Ralph Lauren had the confidence to take numbers up, they didn't take them up enough. In fact, on the conference call, Louvet mentioned that, quote, we remain cautious on the second half of the year due to potential tariff-related pressures on broader consumer behavior, end quote. The stock ended up plummeting, closing down $19.62 or 6.5% as shareholders panicked. Their fears stoked by the fact that the company saw an 18% uptick in inventory year over year. Uh-oh. You can peer into the mind of the skittish owners, and here's what they are thinking. Not only is management worried about tariffs to the consumer, they also have way too much inventory. Now, when I dig deeper, I see the currency fluctuations accounted for 5 of those percentage points. Inventory is only up 13% on a constant currency basis. Plus, I think they were smart to bring in extra inventory before the tariffs went up. But none of that mattered today. Nervous shareholders couldn't take the risk of a shortfall from sweeping tariffs that might make the consumer feel skittish, hence why the stock tumbled more than any other retailer. Now, here's what I think happens. I believe that all the good things that Louvet talked about at the top of the call about the brand, the iconic company, the classic styles, well, I think they're going to win out. I think Ralph Lauren, the company, can navigate its way through this man-made thicket. Still, though, today's action is a textbook reminder and example of what can go wrong as we go into the fall when the tariffs hit. I can't blame anyone, particularly the management of Ralph Lauren, for being cautious. So I buy the weakness in Ralph Lauren, but you have to recognize that this market is rushing headlong toward the stocks of companies with no tariff exposure and away from companies like Ralph Lauren. In that sense, Ralph Lauren was no different from E.L.F. Beauty, which you heard about earlier, doing terrifically, but it's being penalized because of the tariffs. Especially the company either needs to accept lower margins or raise prices, something that will definitely hurt sales. Today, the gulf between the haves, like Palantir, AppLovin, Robinhood, Coinbase, remember Park, P-A-R-C, as I call them, and the have-nots, like an E.L.F. or Ralph Lauren, it's just too great for investors to take. This too shall pass. But the past right now is not prologue. It's a completely different story that has zero connection with the future. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.